BloombergQuint, and you're watching IPO Adda. And my guest today is a company, RateGain Travel Technologies, which is coming out with the IPO on December 7th. Joining me is Bhanu Chopra, who's the founder of RateGain Travel Technologies. To begin with, Bhanu, you are a SaaS provider, which is software as a service provider. Can you take us through the kind of services that you provide?
Sure, absolutely. So first of all, Sujit, thanks for having me on the show. Very, very excited to share RateGain story. It's a company that we built with a great amount of passion and grit. So what RateGain is, we basically a SaaS provider to travel and hospitality industry. We provide what I call a revenue maximization platform that allows our customers to acquire guests, retain them, and have a wallet share expansion. So if I want to get into some details around this, we basically have three lines of services broken down as explained in our DRHP as MarTech, distribution, and DaaS. So let me get into the details for each one of them. On the MarTech business, what we essentially do is we basically manage social media on behalf of hotels. And so what do we do for them specifically? We do really three things. One, we basically engage and help large luxury hotels do brand engagement with their audience on social media, such as Instagram and Twitter. So, you will often find that people are posting pictures or complaining or talking about a hotel stay that they have had. So, on behalf of the hotel, we will engage with that user and help elevate the brand engagement. Second thing that we do is once we find that there is an intent to travel, we will use social media channels to market that hotel to the audience that has demonstrated that travel intent. And the third thing, which is very, very cool that we do, Sujit, is we actually capture the social footprint of the user and then help the hotel personalize the service for them. So for instance, we know Sajid's very fond of yoga basis his social profile that we have built. And basis that, what we will inform when you arrive at the Taj New Delhi is that Sajid is fond of yoga. So they place a yoga mat in your room. So, that enables to elevate the level of customer service that they do. The second thing that we do is basically around distribution. So we connect hotel systems to all these online travel agents and websites that you've heard of, like Expedia, Booking, and Make My Trip. So when Sajid wants to go and find a hotel in Delhi and he's looking across, multiple websites and sees the rates and availability across all the Delhi hotels, that's being powered by RateGain, where we basically taking the hotel rates and real-time availability and helping the OTAs publish that to the users. And then when Sajid makes a booking on any of these websites, all your reservation information automatically flows back into the hotel system. So it's a two-way, call it a technology pipe that we power between the hotel system and the OTA. And then the third line of our business is basically data as a service. So what we do there is basically provide, as travel information is extremely democratized. When you're actually booking a Sajid, I'm sure you've probably done this as well, that you go on multiple websites to find the best deal. So it becomes absolutely critical for our customers who are the hotels, the OTAs, the car rental companies to track what is the rate that they have versus the competition. So we provide this information. And now we've recently, really invested, we've really doubled down, in this COVID year, contrary to what people would believe, and really come out with new additional products and data as a service, which we are calling Demand AI and Rev AI. So what they do is Demand AI basically gives you a sense of what the travel demand looks like, right? So as you can imagine, basis all the COVID-related information that we are getting and the quarantine rules, that are getting reimposed, we are able to depict what the demand would look like. And what travel businesses can do as a result of that is determine what kind of price that they have. And also we give them what is the source of this demand, basis which they can allocate the digital marketing dollars to target to that audience. And similarly, we then take all these pieces of information and basically make a recommendation on how you should price. So this particular offering we call Rev AI. which basically takes what is competition doing, what is the overall demand looking like, what is the utilization rate. So we use an AI ML based algorithm then to make a prediction on how you should price, such that our customers don't leave money on the table when demand is high, and charge appropriately.
Mhm. Okay, you know, that gives me the business model of RateGain. Now let me come to the valuation part of it. We're coming out with a price band of 405 to 425. Uh, how do you value a company? Because in the last 2 to 3 financial years, you've been making loss. And if I look at your RHP, you have given a fair value of around 136.9 when you did your stock option pricing. And at that point in time, the share price was around 147.6. And within a year, it's almost more than double. Not more than double, it's nearly 2x, I would say. So how do you justify the pricing that you're asking for this IPO?
Yeah, Simjit. So, look, we are depending on the lead managers to help us guide us on the pricing band, and they are obviously talking to the investors and giving us a view on what is a fair price. And so, whatever recommendations that they make is what we are leaning on. But let me also talk about investment highlights in how investors should look at this, because I do believe this is a multi-bagger in the future to come, given we have a very, very large opportunity ahead of us. So as I mentioned to you, we are amongst the leading uh, distribution technology companies globally, and the largest SaaS company in India in travel and hospitality. I talked a lot about how we're focusing on innovation. We are AI driven solutions that we are launching for to our large marquee customer base. We service today the top 23 out of 25 global hotel chains, the top 25 out of 30 online travel agents, all the leading car rental companies, all the leading cruise liners. So we have 1,400 customers. So every major supplier and intermediary in the travel ecosystem is our customer. So the growth opportunity is very immense. It's a very, very large marketplace, as out there. As per the Focusrite report that we have in our DRHP, we're seeing a 5 billion market size to 12 billion market size over the next 4 to 5 years. It's about 18% CAGR. And we already have a very, very diverse and comprehensive portfolio of revenue maximization and business critical solutions. Also, we are one of the largest aggregators of travel pricing data in the world. And this coupled with very, very strong fiscal discipline that we have. So if you actually look at our financial numbers closely at an EBITDA level, we are positive. And even in the COVID year, which had an impact on our revenue, and we are seeing a very good bounce back, we still were able to deliver, cash from operations was still positive. We were a cash generative company.
I mean, what I saw was that your EBITDA is positive for the years, but your margins are very thin. I mean, 2.5 to 4% margin, which is there. Is that the normal margin that you're working on, considering that you are a software as a service provider and a data as a service provider, which should actually demand a higher margin?
So actually, if you compare us to our global peers, our gross margins sit at 80%, where SaaS peers usually on average have about 62%. And secondly, also on EBITDA level, if you were to compare to a lot of our SaaS peers, we are actually positive, whereas most of them are negative. But I'll also talk specifically about RateGain and what the past has been with for us. So I would say up until 2018, we were EBITDA positive to an extent of even 25%. And post that, there has been just a huge acceleration on launching additional products, scaling our sales and marketing. So prior to COVID, we were growing 50% year on year, and that acceleration really began to happen post 2018. So up until that, we were a nice little company, but then our ambitions changed, and we wanted to really go dominate because we saw an opportunity. So we really pushed on the accelerator, and as a result of which, our margins, because the focus was on growth, have diminished. But I feel very confident as we sort of go into the future and reap the benefits of some of these investments that we have done in terms of launching new products. We've acquired 3 companies. So what also impacts, Sajid, our numbers is most of the companies that we end up acquiring are loss-making companies, but that's where the magic happens. We turn them around, we make them profitable. So the investment into new innovative products, expanding a sales and marketing team, turning around these companies that we acquire, in the short term, see a margin pressure, but over a long period of time, I see significant margin expansion and going back to the levels that existed prior to 2018.
So what should be the ideal margin when everything normalizes?
Yeah.
The band?
Sujit, look, I'd be hesitant because I'm also still learning the ropes on what I can say and cannot say.
I get that.
But
I'm based on your historical experience.
yeah.
What should be the band that we should look for a company which is involved in SaaS and DaaS?
See, if you were to look, if you were to compare me with the SaaS peers, then I would say you can pick up the list of all the companies, SaaS companies, and you'll find them. None of them actually are margin accretive. So not only are we amongst the first ones here in India to list, but also I would say that it's a difficult comparison to say, but I will say this to you that from where we stand, I do see us going back to the to the slightly higher double-digit EBITDA margins.
Okay. No, but you're saying that in the short term you're trying to do a growth which will be compromising your margins in the short term, but eventually you will go for margins. That's happening. But I also saw that your marketing spends have
let me just correct that. So we are already. Can you hear me?
Up actually, in this last 5 months as compared to last few fiscals. Yeah.
Sorry, Sujit, I missed
Yes,
your question. Can you repeat, please?
I'm saying that I also saw your marketing spends going up this in the last 5 months, which you provided to around 4% or something of the sales, as compared to in 1% or 2%, which has been the case in the last couple of fiscals.
So, Sajid, that's actually as a result of the COVID situation. Everything was paused when we were hit by COVID. But now that things are opening back up, US is one of our one of our biggest markets. 65% of our revenue comes from the US, and things have really opened up there. So, we are actually wanting to get a lion's share as this travel recovery happens, and as a result of which we're really investing into sales and marketing. But having said that, I do not see any margin dilution compared to the last 2 years. We've already investments have occurred already, and I just see expansion of margins from here on, given we will begin to reap the dividends of some of the investments that we've already made. Like, for instance, we've acquired this company just 3 months ago, My Hotel Shop. We're seeing some very, very good recovery. It was a loss-making company, but we're seeing some very good recovery there. We are also seeing huge uptick in travel recovery, and we're seeing good demand for some of the products that we've launched. So we launched 3 new products. It's unprecedented, Sajid. We've never had that in the history of the company, that we launched 3 new products in one single year, and we've already won this. I see, I do not, from here on, I just see the unit economics continuing to get better.
What about revenue from geographies?
Yeah. So Sujit, if you look at some of our customers, we operate largely in the large enterprises within travel and hospitality. So if you look at all the larger chains, international chains, these are all our customers. And what it also helps us, because they're much larger with many thousands of hotels in their portfolio, and usually our business model is that we charge per hotel, right? The deal sizes end up being much larger. So if I look at, the return on our effort in landing a one large customer with multiple thousands of hotels is significantly more than going after the mid market or the long tail, which are individual hotels, because the sales and marketing costs is similar, but the return in terms of the opportunities is maybe not as large. So we have, our focus has continued to be, to continue to dominate and mine some of these larger customers. So if you want to think about RateGain, you have to think about it as a mid market and an enterprise play in the travel and hospitality segment.
Mhm. What about the uh, receivables? Because we've seen that the trade receivable turnover ratios have has increased for you. It was around 65 days on in FY 2020, went up to 105, and now for the 5 months it's at 80. When do you see that normalizing, and what should be that normal trade receivable days for you?
Due to the COVID, the receivable turnover days increased from 65 days in fiscal 20 to 105 days. So it was COVID related. But with the recent recovery, specifically in the US market, the turnover days have reduced from 105 days to 80 days. And we hope it'll go back to pre COVID levels as things come back to normal.
Uh, and when is that expected? And is there going to be any bad debts coming in as a result of that? Are you seeing stress coming in? Because your major travel comes from America and Europe, and those two countries are going through third and fourth wave. So do you see stress coming in as a result of which you will have to give in further concessions to some of your customers?
So I'll go back to the point, Sujit, that I was making earlier about the quality of our revenue and the quality of our customers. These are marquee, customers. They are very, very large $1 billion companies. Some of these companies, they are very, very well capitalized. So I don't see any issues really. I think the worst is behind us. We're seeing huge amount of pent up demand. Of course, there is this trend over the last week that's been talked about a lot. But as far as we can see, and we can see from how I think there is a rapid, what COVID's also done is led to rapid digitization of even hospitality industry. So we are seeing rapid expansion, and because of the labor shortages, and a lot of people that were furloughed in a lot of these companies, there is a significant amount of tailwind that we are seeing in our business because of the rapid need to digitize and automate. So we see it, we see things coming back to normal in the near term, really, actually, in terms of even the trade receivables. I do not foresee from a bad debt perspective, our historical bad debts have been within the 1% range. I don't see it changing.
And about retention rate, we've been able to retain around 90 odd percent, and I think 94% for the first 5 months of current financial year. Do you expect to retain that kind of retention rate for the next financial year?
When things go awry. With the bigger companies, like I said, we don't see such challenges. In fact, we're seeing a lot of them go back into investment, digitization. So I do not see any challenge.
What about your average revenue per customer? How is that increasing?
So the average revenue depends on the product lines that we have. Um, and like I explained, there are three different product lines.
So on a blended basis?
In our DaaS business, its average is about 69,000. In our MarTech business, it's about $27,000 a year. In our distribution business, it's about 90,000.
Okay. And how? What kind of growth rates are you looking in this? Especially, I think distribution will account for a large portion of your revenue. So, where do you see growth coming in the distribution business, and at what rate you're seeing growth coming in there?
So Sujit, like I said, prior to COVID, we were growing north of 50%. And, I see from here on, given all the investments that we have done and the opportunity that exists ahead of us, significant growth. And as you know, I can't, talk about exact growth numbers, but I'll highlight to you, where do I see the growth coming from? So organically, I see very large opportunity within our MarTech business. Just to give you a sense, the overall opportunity size there is about, there are about, just to give you a lay of the land, there are about 1 million hotels that we can sell to. But out of the million, we really only focus on the top 300,000 because, as I mentioned, we focus on the mid-market and the enterprise segment. And within that 300,000, the MarTech business specifically is focused on the top 100,000 upper mid-scale and luxury hotels. And prior to COVID, we were about 400 hotels, and this was through the acquisition that we did of the Chicago-based business. And because of COVID, we saw a lot of customers pause, but now it's come back to almost 400 again. And if you think about it, we've not even penetrated 1% yet. So our immediate focus is to get to 1,000 hotels within the US itself. We are also experimenting, taking this product to UK and Middle East. And then if you think about what we're doing, we're basically doing digital customer acquisition through social channels. It is extendable to other subsegments in travel. So as you know, we work with the leading car rental companies, the leading OTAs, the cruise liners, the vacation rental. So we can go beyond hotels into these other segments, which can also be, another way of us expanding. The other thing that we have done to make the value proposition very, very compelling is we've acquired this German company that I talked about, My Hotel Shop. Now we're able to handle all digital marketing on behalf of the hotel. So we can say to the hotel, look, if you have $100,000 to invest in your digital marketing, give us that money and we will maximize the return that you have on your digital marketing act. So we become the platform for digital customer acquisition for them. So I see a huge opportunity there. On distribution, we are already working with all the large chains. So as they add new demand partners, we are their platform of choice there. And in our DaaS business, I'm very, very excited because we've sort of launched adjacencies that I talked about, right? So earlier we were just giving competitive information. Now we're giving an end-to-end pricing platform. We're saying we'll give you competitive data, we'll give you demand AI, which gives you a sense of travel demand. We'll look at your utilization and then we tell you. So a real example of that is, we had a customer that was paying us $50,000 a year on our DaaS product. But now that we have, unleashed this end-to-end pricing platform, our opportunity, we just signed this 2 weeks ago, where now that customer is $500,000 for us. So it's a 10x expansion because the value that we provide is now 10x. It's an end-to-end pricing platform. So I feel very, very excited. And then, we will continue to focus on M&A as part of our growth strategy as well. As I mentioned to you, we acquired My Hotel Shop. Prior to that, we acquired 2 companies in the US, Disco in Dallas and BCB in Chicago. And I do see that there is going to be continuous opportunities for us to fuel our growth, through consolidating in the industry. And basically three considerations that we look at when we think about M&A. One is this helping us, accelerate our product vision, which I talked about, the RevMax platform, because there are some capabilities that we don't possess, and not everything we want to build, we want to acquire some capabilities. Second, we want to get deeper in certain markets. So as both BCV and Disco were very awesome for us because it got us much, much closer to our big customers in the US. So now we have a significant presence in Dallas and Chicago. And then the third thing we look at is, opportunistically, we want to consolidate by looking at some of our competition in, some of these areas that we operate, such that, we become the dominant players in the industry.
Hmm. Okay, I have two more questions. One is with respect to the fact that when do you see this entire scenario of travel and hospitality normalizing? Uh, I'm not asking in numbers, but as a player, because if the industry normalizes, your revenues are also will head towards normalization. So when do you see that happening? Given the fact that we are seeing challenges coming one after another for the key markets like North America and Europe.
Yeah. So, Sujit, if you ask me, if you'd asked me this question, I would have said I'm seeing incredible travel recovery. Till we heard about the new variant, and if you were to ask, if I were to ask you, what is that one thing that you would like to do as we sort of come out of the pandemic? What would your answer be?
Of course, travel is one of the
Yeah.
things, but
So
my point is, when do you see it to normalizing? Because things are again getting back, getting tighter for this industry.
yeah.
And even tourism came up in a big way, and then again you're seeing some bit of
So
restrictions many countries are now putting in.
So I'll make two comments. I'll give you my personal views, and then I'll back it up with some of the data that I see as well. Because, as you know, we are the largest aggregator of data in the travel industry. So I'll share some anecdotes with you because we've been tracking this since last week. So in terms of my personal views, I think world is much smarter today compared to a year ago. We had no vaccines at that time. We had no knowledge of this virus. I think the world medical fraternity has done a remarkable job. There's a lot of investment that has happened that's resulted in this acceleration of these vaccines. I feel that we are at the fag end of overcoming this pandemic, and I do feel you know I think the recent announcements is very, very cautious by various governments across the world, because I think we've had two occasions where we didn't act fast enough. But I feel things are much different. The world has a lot more tools at their disposal. We have vaccines. Pfizer talked about an antiviral drug that's come out. I know this information is quite new, and we are trying to collect as much information to know more about this variant, but I feel very confident that we'll be able to overcome. I see this is a near term hiccup, but on a longer term basis, I think things coming back to normal, in the midterm really here. I would say if I look at even our data, we are seeing a lot of the cautiousness occur over the next sort of 2 weeks. But there are some cancellations, etc. But I do not see that trend, beyond 30 days. So I think everybody is in sort of a wait and watch mode. I do not believe that we don't understand the ramifications of this new variant. And I do not believe whatever those ramifications are, we are much smarter to be able to overcome them.
Finally, on the borrowings part of it, you have over 100, around 110 crores of borrowing. I think you're using a part of the proceeds to pay down your borrowings there. So will you be on a net basis, net cash positive, or once the IPO is done?
Yeah. So let me talk about actually the user proceeds also. So yes, you are right. Part of it is for repayment of debt we took for one of the acquisitions, and part of it is also, also for a deferred payment related to another acquisition. We're already actually, if you look at our balance sheet today, we're sitting on about 165 crores of cash already. So even without the IPO proceeds, we are net cash positive, net debt positive. And really the larger reason for raising the money is, like I said, to continue to invest in innovation. I feel there's a huge opportunity. And, it reminds me of John Chambers, who talked about in a moment of crisis and calamity is the opportunity to double down. So that's what we've done. And that's why I talked about the three products that we have launched, which are seeing some great traction. So really the proceeds are going to continue to accelerate on innovation, because I believe the future belongs to companies that are innovative. We want to continue to invest in our cloud infrastructure, our data center, and we want to also continue to accelerate through M&A and build capabilities that I talked about that deepen our footprint in certain key markets, alongside repayment of debt.
Bhanu, I've taken enough time of yours this morning. Thank you very much for joining us. The RateGain Travel Technologies IPO opens on December 7th, closes on December 9th with a price band of 405 to 425, giving it a market value of 3,705 crores at the upper end of the price band. Thank you for watching Bloomberg.
Thanks, Ajit. Thanks a lot.